I'm George Hadger, and in today's video insight, I'm going to talk about what really matters when looking at stocks and instances where it's important to cut through the noise. So first off, it's worth mentioning that when looking at stocks, there is no shortage of news flow. Investors are inundated with news, some of it of value and much of it of no value. Often investors give too much weight to recent news and it can lead to a rushed buy or sell decision. While it's important to factor this new information into your thesis, it's worth slowing down and really thinking about the impacts of the news on the stock's valuation and only acting when the news substantially changes your thesis and the attractiveness of that investment. If the new information does materially impair your stock thesis, exit promptly and don't dwell on what price you paid for the stock or whether you've made or lost money on the investment. I'll give a recent example of the global team assessing news flow in the context of one of the positions in the global portfolios. On the 12th of January 2018, Facebook announced changes to its newsfeed that would prioritise posts from friends and family over public content. Over the ensuing days, the stock was down 6%, and there was a lot of negative news flow surrounding this announcement. We took a step back and looked at the expectations implied by the current stock price and continued to believe that they were too conservative. So over the subsequent weeks, Facebook stock rallied 11% to an all-time high. If you were to look at the Facebook stock price chart, it has gone from the bottom left-hand corner to the top right. The stock has appreciated significantly. If you were to just look at the chart, it's easy to jump to the conclusion that Facebook stock has already had a huge rally and it's likely that the stock will run out of steam. I would argue strongly against this chartist approach. In fact, I would to a great extent try to ignore the path the stock price has taken to get to its current level, as it really is a poor indicator of how the stock will perform in the future. Again, it's important to cut through the noise and focus instead on what will drive the stock. That is, what expectations are being implied by the current stock price and whether they are conservative relative to what we think the business will achieve over time. Take, for example, the impact of the recent US tax reforms. The federal tax rate has been lowered to 21%, down from 35%. In essence, firms are now able to keep 79% of their earnings rather than 65%. So they now have approximately 22% extra flowing into the bank each year than under the prior tax regime. This is a demonstrable and immediate change in value that has affected the stock prices of basically all companies in the US. If one were to have looked at the stock price chart of a business that has recently risen 15% and ignored the value addition from the tax reform, they might have missed the fact that the tax change actually boosted the value of the business by, say, 30%. And even the stock, it's still currently cheap, even after the price rise. So it's always crucial to consider how any new information or data points affects your assessment of a stock's intrinsic value. Thanks for listening.